If you want a single word to describe the Japanese yen in the past 5 years, it's probably fragile. Not collapsed, not dead, but constantly on edge. For investors, policymakers, and ordinary Japanese households, the yen has become a daily reminder that Japan's economic playbook, once admired worldwide, is now under serious strain. And just as Japan is struggling to stabilize its currency and redefine its economic future, geopolitics has re-entered the picture. Rising tensions with China, especially following outspoken remarks on Taiwan by figures like Sanae Takaichi, are adding another layer of uncertainty. Currency markets don't just price interest rates and trade balances, they price risk, and Japan's risk profile is changing. Hi everyone, welcome back to Difference Frames the World, a channel to see the world from a different angle. Today, we discuss what really happened to the yen, why it matters, and where things might be heading. First, let us see how the yen slid into crisis mode. The Japanese yen didn't suddenly fall apart overnight. It was a slow-motion crisis years in the making. Japan has one major handicap: ultra-low interest rates in a world that has moved on. While the US and Europe aggressively tightened monetary policy to fight inflation, Japan stayed committed to its long-standing easy money stance. The Bank of Japan's limited options highlight the structural challenges, which may leave people feeling cautious about Japan's future moves. That difference mattered, and it mattered a lot. Currency markets thrive on yield. When investors can earn significantly more by holding US dollars than by holding the Japanese yen, capital naturally flows out of Japan. The result was straightforward: a weaker yen, month after month. By mid-2024, the yen was no longer just weak, it was politically sensitive. Import costs soared. Energy prices hurt households. Food inflation became impossible to ignore. Japanese consumers, long accustomed to price stability, suddenly felt squeezed. The government stepped in with verbal warnings, then with actual currency interventions. These moves caused brief rebounds, but they didn't change the underlying math. As long as rate differentials remained wide, the yen stayed under pressure. By 2025, Japan made some adjustments. The Bank of Japan finally nudged policy away from emergency-era settings. Yield curve controls were loosened. Interest rates moved up, slowly, cautiously, and almost reluctantly. It helped stabilize the yen, but it didn't restore confidence. Why not? Because the problem wasn't just interest rates. It was structural. Japan's economy faces deep challenges, such as a shrinking population, an aging workforce, sluggish productivity growth, massive government debt, and heavy dependence on imported energy. A weak yen can help exporters, but when weakness becomes extreme, the costs outweigh the benefits. Companies importing raw materials suffer. Small businesses feel squeezed. Real wages lag behind inflation. In 2025, the yen stopped free-falling, but it also failed to convince markets that Japan had fully turned the corner. Then enter politics. Sanae Takaichi and the Taiwan question sparked tension between Japan and China, the two largest economies in Asia. These geopolitical tensions add layers of uncertainty, making the investors feel the stakes are high and the situation is unpredictable. Geopolitics is a better word to use here than the word politics, and Sanae Takaichi is not herself where things get more complicated. Sanae Takaichi is not just another politician. She represents a hawkish, nationalist wing of Japanese politics that is increasingly vocal about security issues, especially Taiwan. Her remarks emphasize Taiwan's strategic importance to Japan, but Beijing regards Taiwan as part of China and none of Japan's business. By framing it as inseparable from Japan's own security, she was not subtle. Her remarks were heard loud and clear in Beijing. From China's perspective, Taiwan is a red line. Any Japanese political figure openly aligning with American and Taiwanese security narratives is seen as crossing the line. Bear in mind that currency markets always price in geopolitical risks, so heightened tensions with China over the so-called Taiwan contingency increase risk premiums, affecting the yen. When political rhetoric heats up, investors start asking uncomfortable questions. Could trade relations deteriorate? Could Chinese tourism or investment be restricted? Could supply chains be disrupted? Could Japan be drawn deeper into a Taiwan contingency? None of these needs to happen for markets to react. The possibility alone increases risk premiums. Japan's economy is deeply intertwined with China, its largest trading partner. Japanese manufacturers rely on Chinese production networks. Japanese consumer brands depend on Chinese demand. When relations worsen, even rhetorically, the yen tends to suffer. Here is why. Investors see Japan as more exposed to regional conflict risk. Trade uncertainty weakens growth expectations. Safe haven capital flows shift toward the US dollar instead of the yen. Japanese firms hesitate on long-term investment plans. In the past, the yen was considered a haven. In recent years, that status has faded. High debt levels and ultra-loose monetary policy have changed the equation. Now, geopolitical tensions don't strengthen the yen, they undermine it. Especially when the US is planning to pivot to East Asia, creating another Ukraine there, things become more complex. Japan's alliance with the United States is central to everything. Security cooperation with Washington is stronger than ever. From a defense standpoint, it reassures Japan. From a currency standpoint, it isn't very easy. On one hand, U.S. security backing reduces existential risk. On the other hand, U.S. monetary policy has been one of the biggest drivers of yen weakness. High U.S. rates pull capital out of Japan. And in any major geopolitical crisis, global investors still rush into dollars first. So Japan finds itself in an awkward position. Strategically, it has to be aligned with the US. Economically, it is deeply entangled with China. Monetarily, it is disadvantaged by both. That's not an easy triangle to manage. Japan has tried almost everything to intervene in the yen market. However, currency intervention sounds dramatic, but it has limits. Japan can spend billions defending the yen, but unless fundamentals change, markets eventually overpower policy. And domestically, there's a political balancing act. Raising rates too quickly risks choking off growth and destabilizing heavily indebted companies. Keeping rates too low keeps the yen weak and hurts households. There's no pain-free option. Meanwhile, hawkish voices like Sanae Takaichi's remarks on Taiwan contingency resonate with parts of the electorate, and strong rhetoric abroad can clash with economic reality at home. Japan needs stability, not just militarily, but financially and economically. Looking ahead, the yen's trajectory depends on three big forces. First, the country's monetary normalization is slow and partial. Japan will likely continue raising rates but cautiously. Don't expect aggressive tightening. The goal isn't a strong yen, but a less unstable one. It suggests the yen recover somewhat but not return to pre-crisis levels. Second, the geopolitical risk will be seen as a permanent feature. China-Japan relations are not going back to the warmth of the early 2000s. Taiwan will remain a flashpoint. Even without military conflict, persistent tension will keep a risk discount on Japanese assets. That caps how strong the yen can become. Third, Japan needs structural reform. Without major productivity gains, labor reforms, or innovation breakthroughs, Japan's growth outlook remains modest. A modest growth outlook means limited currency upside. In plain terms, the yen may stop falling, but it won't soar. The Japanese yen is a currency caught between eras. The yen crisis of 2024 and 2025 isn't just about numbers on a screen. It's about a country caught between eras. Japan is no longer the unstoppable export powerhouse of the 1980s. It's not the deflationary puzzle of the 2000s either. It's something new, still figuring itself out. Rising geopolitical tension with China, louder security rhetoric over Taiwan, and a shifting global monetary order all lead to a currency that reflects that uncertainty. The yen's weakness isn't a failure. It's a signal. A signal that Japan needs a new equilibrium, economic, political, and strategic. Until that equilibrium emerges, the yen will remain volatile, sensitive, and deeply tied to forces far beyond interest rates. And in today's world, that might be the most honest price discovery of all. It isn't just a currency problem. Japan, as a country, is wrestling with history, economics, demographics, and geopolitics, all at the same time. The Japanese yen has lost its sense of stability. For decades, the yen symbolized predictability. Even when Japan's economy stagnated, the currency felt anchored. That anchor loosened in 2024 and stayed loose in 2025. It has fallen into a vicious loop. To understand why the yen struggled so badly in 2024 and 2025, we have to rewind, not months, but decades. Japan spent much of the post-bubble era fighting deflation. Prices didn't rise. Wages stagnated. Growth limped along. To counter that, the Bank of Japan became the most aggressive monetary experimenter in the developed world. Zero interest rates. Then negative rates. Then yield curve control. Then massive bond purchases. For a long time, it didn't break the yen because the rest of the world wasn't offering much yield either. But that changed after the pandemic-era inflation shock. By 2023 and into 2024, the US and Europe had raised rates dramatically. Japan hadn't. That gap was the core of the yen crisis. When investors can borrow cheap yen and sell them for a more profitable US dollar, and they can someday sell a more expensive dollar and buy back cheaper yen and return it to the bank, they keep a lot of extra money at hand. They don't hesitate. It wasn't speculation. It was math. Early in 2024, the yen's decline crossed an invisible psychological line. It wasn't just weak, it was politically embarrassing. The Japanese Ministry of Finance stepped into currency markets, spending billions to slow the yen's fall, and it worked temporarily. But intervention without policy change is like bailing water from a leaking boat without fixing the hole. Markets knew this. Traders waited. Pressure resumed. By mid-2025, the yen stopped falling rapidly, but it didn't convincingly rebound. Investors didn't rush back. Confidence remained thin. A weaker yen can help exporters, but only to a point. When currency weakness becomes extreme, it starts hurting the domestic economy more than it helps. Today's Japan is no longer the Japan of the 1980s, when it had a GDP of 75% of the US and an overwhelmingly strong manufacturing base. As a result, the Japanese yen is no longer as important a currency as it used to be, and fewer people take it seriously. It has become a trading tool to make extra cash. A tool is a tool, and people do not care whether it is broken or bent. Even Japan itself has become a tool to contain China, and nobody cares whether over 100 million Japanese are happy or not. When a short-sighted, narrow-minded, belligerent and hawkish person is chosen to mislead the country, the result is obvious and requires no further explanation.